Real estate is not something that you can just, click a sell order and have your cash in 5 days. Private real estate should be for your longer term dollars in that 3 to 7 year range.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today is an episode with me and my friend and partner, Willie Bonati. Willie, thanks for joining.
Yeah, absolutely, Jack. Great to be back again.
So today we want to talk about why your financial advisor has not told you about private real estate funds and syndications. And it's a question that's come up a lot. And we're going to talk about a few reasons why you may not have heard about them, and also some pros and cons, and just an overall analysis of the private funds and private syndications. So a lot of questions we've got. As I said, the number one was why weren't they told? Why hasn't your advisor told you? I've also had people concerned that they just don't have the knowledge, the access, or enough money to invest in these types of deals. And a lot of people are worried about being scammed or just having a much higher risk than something more traditional stock market index funds, etc. And lastly, a lot of questions about liquidity. One of the only good things, in my opinion, about the stock market is, you can generally click a button and sell. That also can be a very bad thing because a lot of people do panic sell. So, So Willie, earlier in your life and career, you actually were a financial advisor. So from your past, why do you think most advisors are not telling their clients about private real estate funds and syndications?
Yeah, Jack, that's a great question. So, there's a multitude of reasons, and the first and really simple one is, that they don't get paid on it, right? So, FAs and wealth advisors make commissions on products they sell, or they make a percentage of the assets that they have under management. And they want all of your investable dollars. And trust me, they're not going to go out of their way to say it may be beneficial to have a portion of your overall asset allocation in real estate or other alternative investments. The second is typically, if you say that you're interested in investing in real estate, they will typically recommend a public REIT, which they do get paid on. However, public REITs do little in diversifying you away from the public market roller coaster. Public REITs have the same exposure to market sentiment and economic outlook as stocks do. They also have unfavorable tax implications in comparison to private real estate. Another reason, which I think you touched on just there briefly, was it is illiquid, and this is true. Real estate is not something that you can just click a sell order and have your cash in 5 days. Private real estate should be for your longer term dollars in that 3 to 7 year range. Another reason is there, high barriers to entry. So private real estate investments often require large minimum investments, $25,000, $50,000, even $100,000, which can make it difficult for some investors to participate. And additionally, in many cases, you need to be an accredited investor to participate. But if you do meet those requirements and have those dollars to put aside in an investment for 3 to 5 years, or 3 to 7 years rather, then it really needs to be on your radar. Another reason is lack of diversification. So if you're only investing in one property, yes, that is true, and it does expose you to a lot of risk. And the last real big reason is, the management and operational risk. If you yourself are doing it, it can be really time consuming. And if you're not experienced, it can lead to a lot of mistakes and financial losses. If you are passively investing and partnering with someone, there is risk that they are also not qualified to manage or operate the property. So that is a risk. So those are really the main reasons that I've heard and seen.
Yeah, it's a really good summary. And as you were talking, I was just thinking about what we've done over the last couple of years and what we try to do to alleviate a majority of those concerns for our partners and our investors in our private real estate funds. And the liquidity is one that that's probably the main trade-off. But as I mentioned, I know way too many people who panic sell when the market drops. So there's actually some benefits to being illiquid, as long as you're not using money you need to live off of in the next 1 to 2 years. Real estate is cyclical, but even 2007 through 2015, if you held for 7 or 8 years, you were net up. So as long as you didn't sell at the bottom and you had the wherewithal to have positive cash flow throughout, it still worked out. It still should have worked out well. It goes back to that dollar cost averaging.
Look, I couldn't agree more with you there. I mean, I was, just to give the audience a little bit more color, I was in the banking and advisory business for 6 years. And in a really tough period, it was basically 2005 to 2011, 12, right? So, the end of good times in 2005 and 2006, and then some really bad times from 07, late 07 to 2010. And one of the things that really kind of frustrated me was, and it's just a reality, right? So it's really emotional for people investing. It's very emotional, and when they see that their account is down 15% or 20%, the inclination for many is, I got to get out of this. This is going to go to zero, or this is so they panic sell, despite my advice or the advice of most advisors would be, well, this is a longer term horizon, like just wait, right? Or buy more because everything's on sale. Like you should be buying when it's down, not selling. And it was, sad and frustrating that, I think a lot of people sell at the wrong times and buy at the wrong time. So, yeah.
Yeah, it's absolutely true. I just, as you were chatting there, I just pulled up the VNQ, which is the Vanguard Real Estate ETF. And, the high of the last 12 months was 113, and, it's at 82 right now. So down well over 25% in the last 12 months. Whereas properties, syndications or funds that were entered last April, interest rates were already moving. So to some extent they were priced into, to funds and syndications at that point. And, those are generally spitting off, the same dividend and are, up in value because of the heavy focus on value add. They've actually increased their net operating incomes. And, if they had fixed rate debt, they're drastically increasing their net operating income. There are some properties with variable rate debt where the interest rate's eaten into it a little bit, but it's drastically better. And over a 3 to 5 year period, it's going to be, a consistent grind higher in net operating income. And because they're professionally managed by a team of investors who also have their own money at stake, unlike any financial advisor. No financial advisor has the same portfolio mirrored as you do, but investing in a syndication deal, the operator is required by the bank to have their own money invested as well and skin in the game. So overall, I think illiquidity, as long as you have enough money to live on, and many people also use money or invest in, they either put money in their retirement accounts, and some use a self-directed IRA even. And if you look at it more like a retirement account and not like a short-term gamble, the illiquidity shouldn't really be a concern especially for accredited investors who already qualify. With that said, there are some barriers to entry for those that are kind of starting out earlier in their career, just haven't quite made that status yet, which is unfortunate, but it's part of life. I wasn't accredited when I was 21 years old myself.
Yeah. I mean, look, diving in a little deeper on the liquidity point there, as we've just said, private real estate is illiquid. And from an overall, financial standpoint or investing standpoint, you really need to have several buckets of money. You need to have emergency funds, short-term, and long-term. And those emergency funds need to be liquid and not at risk of any fluctuation. So, money markets are typically the best for that. Short-term is in that 1 to 3 year range, which could be, an index fund that follows the S&P 500 and has a really low fee, say 30 basis points. And the whole intention of that is the returns are going to be better than money market, but you still have liquidity in the event that you need access to in the short term. Though, if the market is down and you have to access it for some reason, you need to be able to stomach those losses. Then everything else that is long term, you can cut up into an allocation that you're comfortable with. And maybe it's a 50, 30, 20 split. So 50% in stocks, 30% in bonds, 20% in alternatives or real estate. And this is really up to your preference. So, for me personally, I know that private real estate is easily going to beat equities on a total return and tax advantage basis. So all of my long-term money is in private real estate. And there's really no right or wrong here. You can dip your toes in and see for yourself, and then start allocating more over the years as you gain experience and knowledge. Jackie mentioned the high barriers to entry. This used to be the case prior to the Jobs Act in 2012. But in recent years, participating passively in private commercial real estate projects has become a lot more prolific. And if you look, there are a lot more real, reputable fund managers and operators doing this. Another point that I talked about, or another reason that advisors aren't recommending this, is they'll say, "Oh, you won't be diversified." And while this is true, if you only invest in one property, this isn't, it isn't the end all be all, right? If you have enough capital, you could invest in different markets with multiple operators and achieve diversification this way. Though for most that isn't possible due to the overall capital it requires to do that. And this is actually one of the main drivers of why we created the JCAM Diversified Fund, which is to give you access at a $50,000 minimum that provides you with dozens of properties, operators, and markets to help mitigate that diversification risk. I'd like to say that we're the only ones doing this, but we're not. And the last point that I'll dig in a little deeper on is the management and operational risk. And look, if you're doing this yourself and have no experience, it can be challenging and risky and quite frankly not worth it. If you're W-2 full-time and taking on rental properties, what you'll find out really quickly is that's not passive at all. There's a lot more work that goes into that than you may expect. And then if you do decide to be a passive and partner with an operator, you better make sure you understand how to evaluate an operator as well as the property. Again, this is another driver of why JCAM created the Diversified Fund, is we are experienced in sourcing and underwriting private real estate properties and operators, and providing our investors with best-in-class opportunities.
Yeah, that's great stuff. It's definitely a passion of mine, and I know you share it as well, to try to provide people access to these opportunities and get more people more exposure to superior investments outside of the traditional traditional financial
Yeah, I
system.
mean, our tagline is wealth without Wall Street. So
Yeah, yeah, that's great. And so you've actually gotten a number of your friends, colleagues, former business associates in what's the mindset been for shifting, for someone that you knew personally from from never doing something outside of the traditional stock market into jumping into alternatives.
yeah, sure. So a lot of it was, they know, like, and trust me. So that's a big piece of it. And there's also just the general curiosity on wanting to participate, in these type of opportunities. Many of them are looking for yield or better returns than they were getting out of their bond or equity portfolio. And a huge part of it as well has been the tax benefits. So, on many of these multifamily syndications, you can see, 80 to 90% depreciation in the first year. So, those are really were the main drivers, I think. And like once you learn about it, participate in it, and become knowledgeable, there's just no going back, right? I mean, in my opinion and many others, private commercial real estate is far superior to, your standard cookie cutter, investment portfolio in public markets. So.
Yeah, and I think there's a lot of people, and that tends to be a lot of the people we work with that are caught. They're accredited, they're worth between 1 and 10 million, so they've got real assets. But for most financial advisors, it's not enough to really come up with a custom plan. It's just fit into one of these couple boxes of allocations. And I've seen far too many investors that own REITs, and if you're in the top income tax bracket and you have REITs in your portfolio, in your taxable portfolio, you're paying at least 29.6% tax on your dividends. And it's appalling to me that, that advisor did not go over with them that, those are actually non-qualified dividends. If it's in a retirement account, it's, not as bad because you're not paying tax on that. But, comparing that to being in a real estate fund, you're actually showing a loss on paper and receiving the same or higher preferred return as dividend you would have received, and that's ultimately tax deferred generally until the property sells or the fund is in its last year of operations. So, if you factor in 30% more cash in your pocket every year for 4 to 5 years, it's it drastically increases the overall return of an investment. That's just one minor thing. There's a lot of other tax benefits to it as well.
Yeah, I mean, look, we don't want to completely rip on advisors and registered investment advisors, wealth advisors, financial planners, etc. In most cases, they're really great at advising you on how to invest in public markets and put together plans for your family. But, I think they're leaving out a significant piece that's really going to help you become truly wealthy. And that's private real estate. And just, a quick anecdote from my FA days, not one of my clients that was wealthy became wealthy from strictly investing in public markets. Almost all of my really wealthy clients became wealthy from investing in commercial real estate or being a business owner, period. Not one of them got rich or wealthy, from their stock portfolio, or it was, very few.
That's really, really well said. And that just reminds me of another point. And we have a number of other episodes on using self-directed IRA retirement accounts, So for business owners, there's a lot of other options to take control of your retirement accounts as well, which often are just parked with traditional financial advisors. But you can use them to invest in real estate funds, real estate syndications. You can do private lending. And it also opens up a lot of other avenues if you are a business owner to put away a lot more money pre-tax as well. Well more than that $16,000 or $20,000 that you could traditionally put into a corporate 401k plan. And the last point, for those that are still W-2 employees, but if you have changed jobs, I mean, you could actually take your prior retirement account and take control of that self-directed and do these types of investments as well. And that's a lot of people just don't know that that's out there and available.
Yeah. That business, you can, if you're a business owner, you can do a SEP IRA. And then if you change jobs or leave a company, that retirement account can be moved into a self-directed IRA. And even some employee-sponsored plans or employee retirement plans, you can do what are called in-service withdrawals, and basically roll a portion of that into a self-directed IRA. I mean, I tried to do that with my wife's account, because there's maybe like 15 investment options in her retirement plan with her company, and they're all, asset allocation funds. The fees aren't high, but, I would rather have that in, it's long term, so I would rather have that in commercial real estate. But unfortunately, it is what it is, and it can't be moved.
Yeah, but there's a lot of options. Yeah, for most people, there's a lot of options out there, and in being aware of them now, because you never know when life events change, when you move, when you change jobs. So it's important to be educated so that if and when the time is right, you can take full advantage of it. And to be clear, neither of us are currently financial advisors, nor are we planning to be. But we look at this like a mastermind, and love to have strategy conversations with friends, clients, potential investors, and really just help each other figure out the most efficient way we can manage our funds together.
Yeah, couldn't agree more.
Great. Well, I think we covered a lot, and we try to keep these episodes relatively short and sweet. So thanks for coming on and joining me today, and look forward to doing another episode soon.
Yeah, absolutely, Jack. Great to be back, and we'll see you on a future episode.
Great. Well, everyone, please, if you like the episode, please give us a like and a review on iTunes and Spotify. Follow us on YouTube, and we're on all major social media platforms, LinkedIn, Facebook, Twitter, and Instagram. So please reach out on your social media platform of choice, and we'll see you in the next episode.
See you guys. Make it a great day.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.